Hello, welcome to Capital Sensei. Today we're going to take a deep dive into one of the most important investing books ever written, A Random Walk Down Wall Street by Burton Malkiel. We'll unpack his central and pretty controversial idea that the stock market is unpredictable. We'll talk about why a monkey throwing darts at a stock list could, in theory, do just as well as a highly paid fund manager. We'll also cover Malkiel's very practical, step-by-step advice on how you, the individual investor, can build wealth without trying to be a Wall Street genius. And as always, whenever we can, we answer questions in the comments. So if something isn't clear, or if you have your own experience with the strategies we discuss, please share it below. Your questions and stories help everyone learn, and that's how we build a smarter community of investors together. Let's start with the big, crazy-sounding idea at the heart of the book, the random walk. What on earth does that mean? Imagine a man who has had a little too much to drink leaving a bar. You know his starting point is the front door of the bar. But can you predict his next step? Will it be left, right, forward, or a stumble backward? It's impossible to know. His path is, for all intents and purposes, random. Burton Malkiel argues that the day-to-day movements of stock prices are just like that drunkard's walk. The starting point, today's price, is known. But the direction of the next step, tomorrow's price, is completely unpredictable. It's not that there's no reason for the price changes. It's that all the reasons we currently know about are already baked into today's price. The price only moves based on new information. And by its very definition, new information is a surprise. It's random. To understand this, Malkiel breaks down how people try to value stocks into two camps. He calls them the firm foundation theory and the castles in the air theory. Think of them as two different philosophies for figuring out what something is worth. The firm foundation theory is the serious, analytical approach. It's like being a home inspector. You don't care what the neighbors paid for their house. You're going to check the plumbing, the wiring, the foundation, and the roof. In stock terms, this means you analyze a company's earnings, its assets, its debt, and its future growth prospects to calculate its intrinsic value. If the stock is trading below that calculated value, you buy. If it's above, you sell. It's methodical and based on facts and figures. Then you have the castles in the air theory. This one is all about psychology. It's not about what a stock is actually worth, but what people think it's worth, and more importantly, what they think someone else will pay for it in the future. The goal here isn't to build a firm foundation, but to build a beautiful castle in the air that everyone will admire and want to buy from you at a higher price. This castles in the air thinking is what fuels market bubbles. Think about the tulip mania in the 1600s, where a single tulip bulb could cost more than a house. Was the bulb intrinsically worth that much? Of course not. But people bought it because they believed they could sell it to a greater fool for even more. We see this today with certain meme stocks or crazes. The value is driven by hype and crowd psychology, not by the company's balance sheet. Malkiel argues that while professionals pretend they're all firm foundation analysts, a huge part of the market operates on this castles in the air principle. People get swept up in stories and emotions. This is a key reason why predicting the market is so hard. You're not just predicting a company's earnings, you're trying to predict mass psychology. And good luck with that. This leads us to the technical heart of the book, the efficient market hypothesis. Now, don't let the name scare you. It's a simple idea with huge consequences. It essentially says the market is incredibly good and incredibly fast at processing information. So fast, in fact, that it's nearly impossible for an individual to get an edge. There are three flavors to this theory: weak, semi-strong, and strong. Let's start with the weak form. This version says that you cannot predict future stock prices by looking at past stock prices. This is a direct attack on something called technical analysis. You've probably seen it before. Those complicated charts with squiggly lines, moving averages, and patterns with names like Head and Shoulders or Cup and Handle. Technical analysts, or chartists, believe these patterns can signal whether a stock is about to go up or down. Malkiel says this is basically nonsense. He argues it's like seeing shapes in the clouds. You might see a dragon, I might see a rabbit, but it's just a random cloud. The data shows that a stock is just as likely to go up as it is to go down, regardless of what its price chart looked like yesterday or last week. The trend is an illusion. Next up is the semi-strong form, and this is the one that really matters for most of us. This form says that all publicly available information is already reflected in a stock's current price. This includes everything from the company's latest earnings report to news about a new product to the general state of the economy. Let's use an example. Imagine a company, let's call it Innovate Corp, is expected to release a fantastic earnings report. You think, aha, I'll buy the stock right before the report comes out and make a killing when the good news hits. The problem is, thousands of smart, professional analysts with supercomputers are thinking the same thing. They anticipated the good earnings, and their buying activity already pushed the price of Innovate Corp up before the announcement. By the time you, the average person, hear the news, it's already old news to the market. The price won't jump. It will just stay where it is because the good news was already priced in. This is a gut punch to most fundamental analysis, the firm foundation stuff we talked about. It suggests that even if you do your homework and analyze a company inside and out using public data, you're not likely to find a bargain. The market as a whole has already done that work for you, instantly and efficiently. Finally, there's the strong form. This is the most extreme version. It claims that all information, both public and private, including secret insider information, is already reflected in the stock price. Malkiel himself admits this is probably not true. The very existence of laws against insider trading proves that you can get an edge with information that nobody else has. If a CEO knows their company is about to be bought out for a huge premium, they could illegally profit from that. But for 99.9% of us who don't have access to illegal inside information, the market behaves as if the semi-strong form is true. So, if the market is so efficient, what does that mean for the pros? The highly paid fund managers, the Wall Street gurus you see on TV, the experts writing newsletters that cost thousands of dollars a year. Malkiel's conclusion is brutal. Most of them are wasting your money. He presents study after study showing that the majority of actively managed mutual funds fail to outperform the overall market average over the long term. Let that sink in. These are people with PhDs in finance, access to incredible data, and teams of analysts, and they still can't consistently beat the market. And it gets worse. Not only do they not beat the market, but they charge you hefty fees for the privilege of trying. They charge management fees. They have high trading costs because they're constantly buying and selling, and all of those costs eat directly into your returns. Malkiel's famous analogy is that a blindfolded monkey throwing darts at a newspaper's stock listings could select a portfolio that would do just as well as one carefully selected by the experts. Why is this? It's not because the managers are dumb. It's because the market is just that competitive and efficient. It's like a big poker game. If you're playing poker against a table of beginners, you'll probably win. But on Wall Street, you're playing against the best players in the world, who are all playing with basically the same information. It's incredibly hard to maintain an edge. The constant buying and selling by these funds just racks up costs, making their net return, the return you actually get, lower than the market's. Okay, so this might all sound a bit depressing. If you can't outsmart the market, and the pros can't either, what are you supposed to do? Just hide your money under the mattress? No, This is actually the most liberating part of the book. Malkiel says that because investing is this simple, it means anyone can be a successful investor. You don't need to be a genius. You just need a simple, disciplined plan. And he lays out exactly what that plan should be. The first and most important principle is diversification. This is the only free lunch in investing. In simple terms, don't put all your eggs in one basket. If you invest all your money in a single stock, even a great company like Apple or Google, you are taking a massive, unnecessary risk. What if a new competitor emerges? What if a key product fails? Your entire fortune could be wiped out. Think of it like building a championship sports team. You wouldn't build a team with 11 star quarterbacks. That would be insane. You need quarterbacks, linemen, defenders, and special teams. Each plays a different role. A diversified portfolio is the same. You own stocks from different industries: tech, healthcare, energy, consumer goods. You own stocks from different countries: the US, Europe, Asia. You also own other types of assets like bonds and real estate. When one part of your portfolio is having a bad year, another part might be having a good year, smoothing out your overall returns and protecting you from catastrophic losses. Building on diversification is asset allocation. This sounds complicated, but it's just deciding on your mix. How much of your money should be in the risky, high-growth bucket, stocks, and how much in the safer, low-growth bucket, bonds? Malkiel says this is the single most important investment decision you will ever make, far more important than trying to pick the hot stock of the year. He offers a simple rule of thumb to get you started. Take the number 100 and subtract your age. The result is the percentage of your portfolio that you should have in stocks. So, if you're 30 years old, you'd have 70% in stocks and 30% in bonds. If you're 60 years old, you have 40% in stocks and 60% in bonds. The idea is that when you're young, you have a long time to recover from market downturns, so you can take on more risk for higher potential growth. As you get older and closer to retirement, you shift more towards safer bonds to preserve your capital. It's a simple but powerful starting point for managing risk over your lifetime. So, how do you actually buy a diversified portfolio of stocks and bonds without spending all your time researching? This is where the hero of Malkiel's story comes in, the low-cost index fund. If you can't beat the market, he says, then you should just buy the market. An index fund is a type of mutual fund or exchange-traded fund, an ETF, that doesn't try to pick winning stocks. Instead, it simply buys and holds all the stocks in a particular market index, like the S&P 500, which represents the 500 largest companies in the US. When you buy a share of an S&P 500 index fund, you are instantly diversified across 500 of the biggest and best companies in the country. You own a tiny slice of Apple, Microsoft, Amazon, and 497 others. You've achieved perfect diversification with a single purchase. And the best part? They are incredibly cheap. Because there's no high-paid manager making decisions and very little trading, the annual fees for index funds are minuscule, sometimes as low as 0.03%. Compare that to an actively managed fund that might charge 1% or more. That difference might sound small, but over decades, it can add up to tens or even hundreds of thousands of dollars in your pocket instead of the fund managers. It's the simplest, most effective way for the average person to capture the market's return. Next, Malkiel gives us a strategy to deal with market volatility: dollar cost averaging. This is a way to invest that takes all the emotion and guesswork out of the process. Instead of trying to time the market, that is, trying to buy at the absolute bottom and sell at the absolute top, which is impossible, you simply invest a fixed amount of money at regular intervals. For example, you decide to invest $500 on the first day of every single month, no matter what the market is doing. When the market is high, your $500 buys fewer shares. when the market crashes and prices are low, your same $500 buys many more shares. Over time, this automatically makes you buy more when things are cheap and less when they are expensive. It smooths out your purchase price and removes the paralyzing fear of investing a large lump sum at the wrong time. It's a beautifully simple discipline. Another crucial discipline is rebalancing. Let's go back to our asset allocation. Say you're 60% stocks and 40% bonds target. After a great year for stocks, you might look at your portfolio and find that it's now 70% stocks and only 30% bonds. Your portfolio has become riskier than you intended. Rebalancing is the simple act of selling some of your winners, the stocks, and buying more of your underperformers, the bonds, to get back to your original 60-40 mix. This feels completely counterintuitive. Our instincts scream to let our winners run. But rebalancing forces you to do what every great investor does: sell high and buy low. It imposes a discipline that keeps your risk level in check and systematically locks in some gains. Finally, Malkiel spends a lot of time on what might be the biggest obstacle to our investment success: ourselves. He delves into the field of behavioral finance, which studies the psychological biases that cause us to make irrational financial decisions. Understanding these biases is like knowing your enemy. The first is overconfidence. We all tend to think we're above average. Ask a room full of people if they are an above-average driver, and almost everyone will raise their hand. It's the same with investing. We hear about a friend who made a fortune on some tech stock, and we think, I can do that too. I'm smarter than the average person. This overconfidence leads us to trade too much, take on too much risk, and believe we can outsmart the market when all the evidence suggests we can't. Then there's herd behavior. Humans are social creatures. We feel safe in a crowd. When we see everyone rushing to buy a particular stock or cryptocurrency, our fear of missing out, or FOMO, kicks in. We jump on the bandwagon, often right at the peak of the hype, just before the crash. We buy high because everyone else is buying, and then we panic and sell low when everyone else is selling. This is the exact opposite of what you should be doing. Another powerful bias is loss aversion. Psychologically, the pain of losing $100 feels twice as intense as the pleasure of gaining $100. This makes us do irrational things. For example, we might hold on to a losing stock for years, refusing to sell and admit our mistake, hoping it will come back. At the same time, we're often too quick to sell a winning stock to lock in a small profit, afraid that our gains will evaporate. This leads to a portfolio of weeds we refuse to pull and flowers we cut too early. And we can't forget confirmation bias. This is our tendency to seek out and pay attention to information that confirms what we already believe, while ignoring information that contradicts it. If you think a certain stock is a great buy, you'll start noticing all the positive news stories about it and dismiss the negative ones as noise. You build an echo chamber for yourself that reinforces your initial decision, even if it was a bad one. So, what's the grand takeaway from A Random Walk Down Wall Street? Is it a cynical book that says trying is pointless? Absolutely not. It's one of the most optimistic and empowering investment books ever written. Its message is that you don't have to be a Wall Street wizard. You don't need to subscribe to expensive newsletters. You don't need to spend your evenings poring over financial statements or trying to decipher cryptic charts. You don't need to find the next big thing. Success in investing doesn't come from being smarter than everyone else. It comes from having a sound plan and the discipline to stick with it through thick and thin. The path to building wealth is surprisingly simple. It's about accepting the market's efficiency, not fighting it. It's about creating a broadly diversified portfolio with an asset allocation appropriate for your age and risk tolerance. It's about using low-cost index funds to buy the entire market instead of trying to pick individual winners. It's about investing consistently through dollar-cost averaging and periodically rebalancing to maintain your strategy. And most of all, it's about understanding your own psychological biases and not letting fear and greed derail your long-term goals. Malkiel's work essentially democratized investing. He took it out of the hands of the so-called experts and gave a clear, evidence-based roadmap to regular people. The random walk isn't something to be feared. It's something to be embraced. By accepting it, you free yourself from the impossible task of predicting the future and instead focus on the things you can actually control: your savings rate, your costs, your asset allocation, and your own behavior. And in the long run, that is the surest path to financial success.